Today's topic is depreciation. I'm Leandra Lederman.
Hi, I'm Orly Mazur, and I'm a tax professor at SMU, and it's time to break into tax.
Depreciation is just one form of cost recovery of assets. There are several forms of cost recovery. Depreciation is for tangible assets. Amortization is for intangibles, and depletion is for natural resources such as minerals.
The focus of this video is depreciation deductions. Let's take a closer look at this cost recovery method. Section 167 is the code provision that authorizes us to take depreciation deductions. Section 167 says that the general rule is that there shall be allowed as a depreciation deduction a reasonable allowance for the exhaustion, wear and tear, including a reasonable allowance for obsolescence, of property used in a trade or business, or of property held for the production of income.
Notice also that in section 167B, there's a cross-reference. The statute actually directs you to code section 168 with respect to property to which that section applies, and we will come to that later.
So first thing to note is that the depreciation deduction is for exhaustion, wear and tear. This means that the asset must have a discernible useful life. Or put another way, this means that this must be a wasting asset. For example, unimproved land does not have an ascertainable useful life. It is not a wasting asset. It is not considered to wear out over time, so land is a major example of an asset that is not depreciable.
Notice also that section 167 limits the use of depreciation deductions to two categories of property: property used in a trade or business and property held for the production of income. So that means that personal use property is not depreciable. So for example, your personal residence or a personal vehicle that you use only for personal purposes, those are not depreciable assets.
But why are depreciation deductions even allowed? Well, we have depreciation deductions to measure net income. In other words, we're trying to match the expenses against the revenues they help produce.
That's right. So take the example of a widget making machine. Maybe that machine will be useful in the taxpayer's business for something like 5 to 10 years. And during that time, it will produce widgets. If there were no deduction at all allowed for that widget making machine, that doesn't really reflect the cost of using up the machine as it's producing widgets over time. On the other hand, if we allowed the taxpayer to deduct the entire cost of the machine up front, that accelerates the deduction while the income that the machine is actually producing comes in over time. So what depreciation deductions in general try to do is provide that kind of matching that the deductions for using up the machine correspond to the period of time that that machine is actually producing income that's subject to tax.
Now that we know what assets can be depreciated, we need to know the basis for which the depreciation deduction may be calculated. Section 167C helps us out here. It tells us to use the asset's adjusted basis as determined under Section 1011 to calculate our depreciation deduction.
And notice specifically that Section 167C says to use the gain basis. Assets can have gain and loss bases, and Section 167C specifically says use the adjusted basis provided in Section 1011 for the purpose of determining gain.
So we would just use the normal basis calculation rules that the Break into Tax video, initial basis of an asset, discusses to calculate the amount of our depreciation deduction. This basis will serve to be the maximum amount of depreciation deductions that a taxpayer can take with respect to an asset.
In addition to the fact that depreciation deductions cannot total more than the property's basis, Section 168B4 provides that salvage value shall be treated as zero. And what that means is that even though after a property is used up by the taxpayer's business, there might still be some residual value, maybe scrap metal or something like that, that the taxpayer can get out of the property, that's deemed to be zero by the code, which means that the taxpayer can claim depreciation deductions over the life of the asset that total the entire basis. Nothing needs to remain.
This brings us to section 168. Once you've figured out whether or not property is depreciable under section 167, you next go to section 168 to see the manner in which we take the depreciation deduction. Put another way, we go to section 168 to calculate the amount of our depreciation deduction. Note, though, that section 168 only applies to tangible property. This means property that can be moved or touched. Note that section 168 is an accelerated cost recovery system. This just means that a taxpayer can recover their basis in an asset faster than it would otherwise be entitled to under prior depreciation rules.
So how do we calculate depreciation deductions under section 168? Well, section 168A provides 3 elements that you need: the applicable depreciation method, the applicable recovery period, and the applicable convention. And then subsequent subsections in section 168 go into detail on each of these. So you see the applicable depreciation method in subsection B, the applicable recovery period in subsection C, and the applicable convention in subsection D. The applicable depreciation method refers to what percentage of the property you take as a depreciation deduction each year. So for example, we could think of straight line depreciation as sort of a default and an easy approach to depreciation. And the straight line method of depreciation would be where an equal percentage is taken each year. So as a very simple example, if you depreciated property over 5 years, then the straight line method would be 20% of the property's basis per year taken as a deduction if we're just looking at depreciation method. For most property covered by section 168, the applicable depreciation method is the 200% declining balance method, also known as double declining balance. And that switches to the straight line method for the first taxable year in which using the straight line method would provide a larger depreciation allowance.
The straight line method is the method that applies to real property. And in addition, where another applicable method applies to property, a taxpayer can elect to use the straight line method. You usually won't see this happen very often because that causes the cost recovery to be much slower.
So that's just a quick intro for now to applicable depreciation method. Now let's turn to what the applicable recovery period is.
So instead of looking to the actual useful life of property or the number of years a taxpayer is expected to use an item of property, Congress essentially standardized useful life. It assigns property a certain useful life or recovery period based on the type of asset that you're trying to depreciate. Section 168C provides you with these recovery periods. These recovery periods represent the period of time that it takes you to recover your basis in the property. Now, to determine the recovery period for an asset, you need to know its classification. This, in turn, depends on the class life of the property. In other words, to determine an asset's recovery period, you first need to determine the asset's class life. Section 168I1 and Revenue Procedure 8756 set forth the class life for the different types of property. Second, once you know the class life, then you look to section 168E and it tells you the property's classification. Finally, once you know the property's classification, you then look to section 168C and that tells you the property's recovery period.
So section 168E provides for classification of property, and it says that except as otherwise provided in this subsection, property shall be classified under the following table. So generally speaking, if the property has a class life in years of 4 or less, and that class life is determined from the revenue procedure, then it's treated as 3-year property. Or if it has a class life in years of more than 4 but less than 10, it's treated as 5-year property, as a couple of examples. But the statute itself also provides recovery periods for certain specific types of property. So for example, residential rental property and non-residential real property are covered by statute. In addition, in section 168E3, some of these categories like 3-year property and 5-year property include specific listed items. So for example, 5-year property includes an automobile or light general purpose truck. So what do you do if you find that under the class life in years, according to this table, that an automobile or light general purpose truck is not 5-year property? Which trumps, the table or the statute? Before you resort to canons of statutory interpretation, notice that 168E1 says, except as otherwise provided in this subsection, property shall be classified under the table. And it is otherwise provided in the subsection that an automobile or light general purpose truck is 5-year property. So that's what trumps. Let's now turn to the applicable convention. So what does this convention refer to? What it is a simplification regarding when depreciation begins and when it ends. In theory, to be technically accurate, depreciation would begin the day that the taxpayer placed the property in service in their business or income producing activity and would end the day that they took the property out of service. But for convenience and to avoid manipulation, what the statute provides is just simply conventions that deem the property to be placed in service at a certain point of the year, and the same thing for when the property is taken out of service for a year in which that occurs.
The applicable convention is defined in section 168D. The applicable convention only applies to assets that are depreciated under section 168. The general rule is that tangible personal property uses the half-year convention. This means that regardless of when the property is actually placed in service, it will be treated as if it was placed in service in the middle of that year. The half-year convention does not apply to real property. There is an exception to this half-year convention rule, though, and when substantial property is placed in service during the last 3 months of the taxable year, then the mid-quarter convention applies to the entire group of properties instead. Notice again, this only is with respect to properties that would otherwise be subject to the half-year convention. So again, do not include real property in this calculation. And finally, the mid-month convention is the applicable convention that applies to real property. And that is treated as if you place a property in service in the middle of the month in which you actually place it in service.
So notice that real property is treated distinctly from other tangible property for all of the elements of section 168. For the applicable depreciation method, it uses straight line depreciation, whereas other tangible property generally uses double declining balance. For the applicable recovery period, the recovery periods for real property are just much longer than the recovery periods for other tangible property. And then when it comes to the applicable convention, real property always uses the mid-month convention, and the other tangible property uses the half-year convention as a default, with the mid-quarter convention applying if the special rule comes into play.
So if you determine the applicable method, the applicable recovery period, and the applicable convention, then you can use the tables in Revenue Procedure 87-57 to help you quickly figure out the depreciation deduction. For example, if you look at Table 1, it applies when you're using the double declining balance method and the half-year convention. So if you have 5-year property, for instance, you would look to the column for the 5-year recovery period. The numbers listed in that column reflect the percentage of the undeclined balance allowed as a deduction in each recovery period, and already takes into account the applicable convention. And when using the double declining balance method, the table also automatically switches to the straight line method in the correct year. For example, if you have 5-year property with a basis of $10,000, in year 1, you would take $10,000 times 20%, which gives you a $2,000 depreciation deduction in year one. In year two, you would take $10,000 again and multiply it by 32% for a depreciation deduction of $3,200. You would do the same thing for each of the following years that you own the property. Note, though, that the table assumes that you hold the property for the entire recovery period. This means if you dispose the property early, you would need to multiply the depreciation deduction by the applicable convention in the year of the disposition.
As property is depreciated, the code also requires that the taxpayer's basis in that asset be reduced. So Code Section 1016, adjustments to basis, requires proper adjustment for all kinds of things that are done that affect basis. But one of them is adjustments to basis in respect of any period after this effective date in 1913 for exhaustion, wear and tear, obsolescence, which are forms of depreciation, as well as amortization for intangibles and depletion for minerals. And this is to the extent of the amount that's allowed as deductions in computing taxable income and resulting in a reduction in taxes, but not less than the amount allowable as a deduction under this subtitle or prior income tax laws. So if the taxpayer is entitled to a depreciation deduction, but does not actually take it, the taxpayer's basis in that asset is nonetheless reduced. And as the depreciation deductions are allowed or allowable, the property's basis progressively decreases until ultimately, if the taxpayer fully depreciates the asset, the taxpayer's adjusted basis in that asset would be zero. So let's turn back to example one and highlight the effect on the taxpayer's basis of depreciation deductions. So in that example, the taxpayer's initial basis in the asset was $10,000, and the chart told us that the first year's depreciation deduction was 20%. That was a $2,000 deduction. So what the taxpayer will do, in addition to claiming a deduction of $2,000, is reduce the basis in the asset. So now going into year two, the taxpayer's adjusted basis in that asset is $8,000. And that will continue through the recovery period. So for example, the next year, the taxpayer takes a deduction of 32% or $3,200, and the taxpayer's adjusted basis in the asset is then $4,800. Notice that for 5-year property, that property is actually depreciated over 6 years. That's because the first year only has half of the normal depreciation deduction. Then you have the 4 years of full depreciation deductions, and then the remaining half year comes at the end. So it totals up to 5 years, but it's actually spread out over 6 years.
Let's see now how the straight line method of depreciation works.
So assume that the taxpayer purchases non-residential real property, and this would be something like an office building or shopping mall, and the taxpayer places that property in service in January. Assume that the taxpayer paid $390,000 for it. That's the taxpayer's depreciable basis. Code Section 168 treats the salvage value as zero, so the taxpayer will be able to recover the full $390,000 of basis over time if the taxpayer keeps the property in service for its full useful life. For non-residential real property, the recovery period is 39 years. And because that period is so much longer than the periods applicable to other tangible property, non-residential real property, like other real property, will have its own chart. The applicable convention for all real property is mid-month, and the applicable depreciation method for all real property is straight line depreciation. So with the $390,000 basis and a 39-year recovery period, 1/39th of the property using the straight line method would be deductible each year. In other words, as a baseline, a $10,000 depreciation deduction each year. But in the year the property is placed in service, the mid-month convention applies. The property was placed in service in January, the first month. So if you think about the calendar, what that means is that halfway through the first month, out of 12 months, the property is deemed to be placed in service. So you have 11 full months and 1/2 month out of 12, or 11.5 out of 12 needs to be multiplied by that baseline $10,000 depreciation deduction. And that gives you a deduction of $9,583 for the first year. In years 2 through 39, you'd have the full 10,000 depreciation deduction. And then in the final year, year 40, you'd have the $10,000 depreciation deduction, but that other half month would come into play. The applicable convention would give you 0.5 over 12, or a depreciation deduction of $417. And of course, you could also get these numbers by applying the applicable chart and simply using the undeclined balance of $390,000 and plugging that in by multiplying the percentage in the chart for the year in question. And that would give you the depreciation deduction for a particular year. So there are obviously a lot of moving parts here to calculate a depreciation deduction. So we've put together this checklist that should be helpful in keeping track of the various components.
First thing you have to have is depreciable property. That's assets used in a trade or business or held for the production of income and that have a wasting life or a useful life.
And then your basis for depreciation is the gain basis in the property as determined in Code Section 1011.
Remember, the asset's entire basis is depreciable because the salvage value is treated as zero.
Before you take depreciation deductions under Section 167 and 168, you should check if the property can be expensed under Code Section 179 and whether there's bonus depreciation available under Section 168K. Those are not topics we covered in this video, but we're reserving them for a future video.
Any basis that's left over after you take into account those extra depreciation deductions, you recover under Section 168, which was the topic of this video. The annual deduction depends on the applicable depreciation method, the applicable recovery period, and the applicable convention.
The applicable convention applies in both the year the property is placed in service and the year that it's disposed of. It's built into the charts for the year that the property is placed in service and for the last year, as long as the taxpayer fully depreciates the property. If the taxpayer removes the property from service before it's fully depreciated, then the taxpayer has to mechanically apply that applicable convention in the year of disposition.
Remember that you can also use the tables to help facilitate the calculations. Just be sure you're using the right table. It depends on the applicable convention, the applicable method, and the applicable recovery period.
And then reduce the basis in the asset for the amount of depreciation that's allowed or allowable.
This has been Depreciation Deductions. Thank you for joining us as we break into tax.
Don't forget to like this video, share it with your friends, subscribe to the Break Into Tax YouTube channel, and turn on notifications so you don't miss a single new video.